and Namaskar. Over the past few months, the global economy has been shaped by heightened uncertainty, disruptions to key trade routes and supply chains, increased market volatility, and cautious business sentiment. Let me at the very outset emphasize that the Indian economy entered this episode of global turbulence with much better fundamentals than in previous similar episodes. We remain confident to withstand these shocks with minimum pain. Nevertheless, it is important to not only confront and address these challenges, but also at the same time take this as an opportunity to further enhance our resilience. Global economic outlook remains clouded by the continuing geopolitical impasse in West Asia, as sharply escalating energy prices and global supply chain disruptions continue to hinder economic activity. Faced with difficult trade-offs, monetary policy has turned more cautious. Major advanced economy central banks are likely to pivot towards monetary policy tightening. While equity markets remain buoyant, driven by AI-fueled optimism, global bond markets remain bearish amidst renewed inflation fears and continuing debt sustainability concerns. Risk-off sentiments and safe haven demand are imparting volatility to forex markets, with a depreciating trend in many EMI currencies. In this backdrop, the Monetary Policy Committee met on the 3rd, 4th, and 5th of this month to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate under the LAF unchanged at 5.25%. Consequently, the STF rate remains at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly set out the rationale for the decisions of the MPC. The committee noted that the global environment has deteriorated since the last policy meeting in April, with the conflict lingering amidst a fragile truce. The adverse implications of the extended disruption in supply chains and elevated energy prices are reflected in the moderation of growth and increase in inflation projections from the April policy, and I'll come to these a little later. CPI inflation remains below the target despite global shock, as the pass-through to domestic prices has been limited, while the baseline projections point towards headline inflation firming up towards the upper tolerance level in Q3 this year. The impact of the supply shock is expected to wane Q4 onwards. The underlying inflation pressures continue to remain benign at this juncture. However, generalization of inflation through second round effects on expectations and wages is a distinct possibility warranting a close vigil. The outlook also remains clouded due to the subnormal southwest monsoon forecast and El Nino risks. As for growth, the MPC noted that elevated energy prices coupled with global supply constraints are having adverse spillovers on economic activity. While domestic demand remains resilient and manufacturing and services sectors activity continue to expand, there are incipient signs of moderation in some sectors as suggested by high frequency indicators. The MPC was of the opinion that there are considerable risks to the baseline assessment of inflation and growth, which I am going to present shortly, due to the uncertainty about the duration and intensity of the conflict, magnitude of its spillover effects, and the pace of restoration of supply chains. Additionally, the food outlook too remains uncertain on account of subnormal southwest monsoon forecast and El Nino. Although risks of higher inflation have amplified, the MPC felt it would be prudent to wait for greater clarity to emerge. Accordingly, the MPC voted to keep the policy repo rate unchanged. At the same time, the MPC will continue to remain data dependent and closely monitor the developments, including supply side pressures getting embedded in the general price level and inflation expectations. As mentioned, the MPC also decided to retain the neutral stance. I now come to the assessment of growth and inflation. First of all, growth. The second advanced estimates released by NSO placed India's GDP growth for last year at 7.6%. This is owing to strong expansion in private consumption as well as fixed investment. Robust performance of manufacturing and services sectors were the growth drivers from the supply side. As per several high-frequency indicators, domestic economic activity remained largely steady even since the outbreak of the conflict. India's manufacturing and services PMI further suggests that both sectors continue to be resilient and business expectations are still positive. On the demand side, private consumption aided by discretionary spending has remained resilient so far. Fixed investment has also maintained its momentum despite cost pressures. Merchandise exports recorded strong growth in April this year. This is notwithstanding elevated freight and insurance costs. Services exports are also holding up well, reflecting sustained demand despite concerns about AI. Overall, the economic situation has broadly exhibited resilience and withstood the conflict spillovers, although the impact of cost pressures is becoming visible. Going ahead, the rise in prices of energy and other inputs, coupled with supply disruptions, is likely to weigh on economic activity. While import diversification in affected commodities is likely to improve supply, it would still come at a higher cost. The full impact, however, will depend on the duration of the conflict, the time taken for normalization of supply chains, and the burden sharing approach among the various stakeholders. The pass-through of higher energy prices to retail products is also becoming evident. Additionally, the projected deficiency in the southwest monsoon will have implications for agriculture production and rural demand. However, the programs and initiatives for crop diversification, water harvesting and conservation, climate resilient practices and short duration crops, among others, are expected to mitigate the impact. Sustained momentum in services, continuing impact of GST rationalization, and broadly stable employment conditions should continue to support urban consumption, even though rising inflation could be a drag on the purchasing power of households. Government capex is expected to remain robust, while the elevated capacity utilization and sustained credit flows from bank as well as non-bank sources are supportive of corporate investment. Cost escalation and heightened uncertainty could, however, dampen investor sentiment. Weak global demand and high logistic costs are also headwinds for merchandise exports. Services exports, on the other hand, are expected to sustain their momentum as demand for Indian services remain healthy. Several measures undertaken by the government, including support to MSME and export sectors, efforts to ramp up domestic gas and crude production, encouraging use of domestically produced alternatives to imported inputs, and diversification of critical imports should help cope up with the external shock. Taking all these factors into consideration, real GDP growth for this year is now projected at 6.6%. We had earlier projected 6.9%, of course, with huge uncertainty and downside risks. With Q1 now projected at 6.6%, Q2 at 6.3%, Q3 at 6.5%, and Q4 at 6.8%. Prolonged global supply chain disruptions, volatility in global financial markets, and weather-related shocks continue to pose downside risks to the domestic growth outlook. I will now talk about our inflation assessment and outlook. Although firming up marginally from 3.2% in February, headline CPI inflation was below the target during both March and April this year. In fact, 3.4% and 3.5% respectively. While food inflation edged up, fuel inflation remained muted as retail prices of petrol and diesel were unchanged in March and April. Core inflation remained stable at 3.7% during March and April. Excluding precious metals, core inflation was much lower at about 2.1 to 2.2% during this same period. International crude oil prices, the Indian basket, have averaged around 110 US dollars per barrel during the last 2 months. And indications are that the average oil prices for this year would be substantially higher than what were assumed during the last policy. You may recall that in the last policy we had assumed crude oil prices to average for this year at $85 per barrel. Higher energy prices and an increase in several input prices also led to a sharp spike in WPI inflation in April. It was more than 8%. Turning to the inflation outlook, the partial pass-through of high global crude oil prices to domestic pump prices of petrol and diesel started in May. Prices of several inputs such as commercial LPG, industrial raw materials, chemicals, base metals, rubber, and plastic products, among others, have increased. These could exert upward pressure on CPI inflation in the coming months as firms pass on these higher input costs. Considering all these factors, CPI inflation for this year now is projected to be at 5.1%, about 50 basis points more than earlier projected, with Q1 at 4.2%, Q2 at 5.1%, Q3 at 5.9%, and Q4 at 5.4%. Core inflation is projected at 4.7% for this year. These forecasts, I may mention, are subject to upside risks due to heightened uncertainty because of a variety of reasons: global supply chain disruptions, global commodity price shocks, uncertainty about the spatial and temporal distribution of the southwest monsoon, and risks from El Nino conditions getting developed. However, I may mention that adequate stock of food grains and satisfactory reservoir levels provide a lot of comfort to us. I now move to liquidity and the financial market conditions. System liquidity, as measured by the net position under the LAF, stood at an average daily surplus of 2.63 lakh crore rupees since the last MPC meeting in April. The Reserve Bank proactively undertook durable as well as transient liquidity measures to ensure that there is appropriate liquidity in the banking system. Going ahead, we expect that the usual drawdown of government cash balances after the transfer of RBI surplus and the return of currency during the monsoon season will aid banking system liquidity in the near term. Since the April meeting, the weighted average call rate traded within the policy corridor, while short-term money market rates, especially rates of CPs and CDs, commercial papers and certificates of deposits, moderated before coming under pressure again in May. G-Sec yields eased in April following the ceasefire announced in West Asia, but firmed up in May. Transmission in the credit market has moderated during March-April with some hardening in deposit and lending rates. However, it is still quite robust. The Reserve Bank going forward would continue to ensure appropriate liquidity in the banking system to meet the productive requirements of the economy and facilitate further monetary policy transmission. As per the latest available data, credit from all sources last year YOY grew by 15.4%. This is in comparison to 12.1% recorded the year before last. Bank credit, in fact, has been even more robust at 16+%, and it is broad-based as market-based funding became costlier. Coming to financial stability, the system-level financial parameters, as I mentioned in my last April statement, relating to capital adequacy, liquidity, asset quality, profitability of scheduled commercial banks, these continue to remain healthy as earlier, although there is some moderation in profitability as compared to the last year. Similarly, the system level parameters for NBFCs too are very sound, with adequate capital and improved GNPA ratios. I will now speak about the external sector. It successfully navigated the challenges of elevated tariff and trade-related uncertainties last year amidst a turbulent global economic environment. The surge in energy prices and persistent trade policy uncertainties continue to pose upside risks to India's current account deficit this year. Services trade surplus and inward remittances, however, are expected to provide some comfort. On the external financing front, buoyant gross FDI and higher net FDI last year, we had record gross FDI of more than $94 billion and a net FDI of about $7 billion. These underscore the continued interest of global investors in India. FDI flows have been rather encouraging even in April. This year, in 26-27 till 2nd June, net FPI to India, however, witnessed outflows of almost $14 billion, primarily in the equity segment. Nevertheless, as per the latest available data that we have with us on May 29-26, India's forex reserves stood at a very healthy $682.3 billion US. These are adequate in terms of the standard metrics of reserve adequacy, with an import cover of about 11 months and external debt cover of 89+%. Various policy initiatives over the recent months are expected to further strengthen and support our balance of payments. These include the recent agreements with major trading partners, some of which have now come into effect, opening of the insurance sector to 100% FDI, ethanol blending program, which has been a great success, push for energy transition, which is gaining momentum, easing of FDI restrictions for land bordering countries, liberalization of the ECB framework, which was announced some time ago, and several others. To attract foreign capital, I also have a few measures to announce today. First, for government securities under FAR, which is the fully accessible route, we are expanding the universe of specified securities by including all new issuances of 15, 30, and 40-year tenor G-Secs. Till now, only securities, government securities up to 10-year tenor were included. In addition, limits pertaining to short-term investment, concentration, and individual securities on FPI investment under the general route are being removed. The government recently, this morning, has provided tax benefits to government securities. All these measures together should help attract foreign capital for government borrowing. Second, the limits for investment by NRIs and OCIs in equity instruments traded on the stock market without SEBI registration are being increased. Further, the same facility is being extended to all individual persons resident outside India at par with that available to NRIs and OCIs. Third, a facility of concessional forex swap will be provided for about 4 months till 30th September 2026 to incentivize ECB's external commercial borrowings by public sector undertakings. Fourth, a similar facility for bearing the full hedging cost shall be provided again till 30th September to the authorized dealer banks for raising 3 to 5 year FCNRB deposits. Fifth, it is proposed to restore the time for realization of export proceeds to 9 months. This was earlier increased to 15 months. I may mention that while these measures are expected to strengthen our balance of payments, we will continue to make the right policy adjustments as may be required to further promote exports and attract and incentivize capital inflows. As I have often reiterated, a word on our exchange rate policy, it continues to remain unchanged. We do not target any specific level or band. Instead, we allow the exchange rate to be determined by market forces. Our experience, however, suggests that it may sometimes witness movements, often caused by speculative pressures, especially in the wake of heightened uncertainty, some of which we witnessed recently, which are not in sync with the fundamentals and are disruptive of economic activity. While our objective is not to resist market-driven adjustments, we shall curb excessive volatility and prevent disorderly market movements. While our foreign exchange reserves provide us with sufficient buffer against external shocks, we have a very broad range of regulatory and market-based instruments to respond effectively as may be required. In this regard, we shall remain vigilant, and we are fully prepared, as I mentioned earlier, to do whatever it takes to preserve an orderly market conditions. To conclude, global economic conditions and sentiments continue to be frayed without any meaningful resolution of the West Asia conflict. While these have adversely impacted the domestic growth inflation outlook, the economy at this point is relatively strong. We shall put in place policies to meet the challenges while taking measures to further strengthen the macroeconomic fundamentals of the country. Thank you, Namaskar, and Jai Hind.